Oil prices are nearing new lows this Monday as a historic oil rout deepens. The U.S. benchmark, West Texas Intermediate crude, also briefly fell to $34.53 a barrel before erasing some losses to trade flat. Brent crude tumbled to a low of $36.33 a barrel, below its close of $36.61 a barrel from December 2008. The moves are sending jitters through the markets, which are already eyeing the Federal Reserve's decision on interest rates slated for Wednesday with some anxiety. Here to put the news into context for us is WSJ's Heard on the Street deputy editor Spencer Jakab. Spencer, thanks so much for being with us.
Thank you.
Is there any one reason being cited for this decline in oil prices?
The big reason is that there's just lots and lots of oil being pumped. So OPEC had a meeting in Vienna that resulted in them basically throwing up their hands and saying, we'll let the market sort it out. And you know, there are a lot of factions within OPEC, but the Saudis always have been the kingpin, moving the cartel one way or another. And now they basically said, we're not going to be a cartel anymore because we can't be, because they're, you know, the prices are very low, yes, but none of us are going to stop printing, pumping all out.
Right.
And you have the Iranians who are going to be relieved of sanctions probably in the beginning of next year, who are going to start pumping a lot more. And they don't want to, just as they're coming back onto the market, stop pumping. And so it's a kind of a prisoner's dilemma situation.
And add to that, temperatures have been strangely warm this season, so there's not a huge, demand for heating oil. What are experts saying? Do they expect this route to continue? What's the forecast?
It could continue. So today, natural gas futures actually, when that's the main U.S. heating fuel, hit the lowest in almost 14 years because of these really mild temperatures that we're having heating oil. The experts are saying that we could go a lot lower, and there's one event that could send us sharply lower, at least for a brief period of time, which is that we're actually running out of space to put all this oil because everyone's pumping all out. No one's cutting back, and there's only so much place to put it. Once you get to the point where there aren't depots on shore around the world and people continue to pump flat out, then you have to store it on super tankers and just park them out in the sea. And then that's a really extreme situation.
Absolutely. Let's talk about the timing of this. How significant is it considering the Fed's expected announcement on Wednesday?
Now, if you'd asked me 3 or 4 weeks ago, I would have said it's not significant at all, because what they've always said is that it's transitory. We're not going to pay attention to commodity prices going up, going down. That dampens inflation, but we're going to focus on inflation and things like that that are stripped of food and energy, all these volatile commodities. Now, though, all these commodities, not just oil, are near multi-year lows. And that is creating pressure on companies that mine those commodities, and it's creating a rout in the high-yield bond market.
Right.
And that is creating financial ructions, and that's something that is very much something the Fed is concerned about. And so, they're still very likely to raise, but they're likely to be very cautious in their language and maybe give some reassuring words, just because they are a bit concerned about what's going on in that very important corner of the market.
And then does it raise doubts on further interest rates down the line?
It does. I mean, it raises doubts. I think they're still very likely to raise, but it raises doubts on how aggressively they're going to raise. The consensus of economists polled by the Wall Street Journal is that a year from now we'll be a full percentage point higher than we are now in short-term rates. That might be too bullish. And if you look at where we've been, let's go back 6-month increments and look at how much economists expected rates to be higher a year later. They've always been a little bit too bullish in terms of where rates will be, and that might turn out to be the case today if this really turns into a major dislocation based on energy.
Absolutely. And what other sectors are being directly impacted by oil's fall?
Well, it's having impacts on, airlines obviously are really enjoying this, and there are a few sectors of the economy that are really enjoying it. But the rout in energy is hitting parts of the energy market that people thought were immune or not very exposed. For example, a lot of income investors, people have been so starved for income for years, 7 years of low rates. And so people have put money into MLPs, which is a sector. It's like a real estate investment trust type vehicle, but it's specific usually to energy, things that produce resources, because you could get some income from those things. And these are companies that own pipelines and depots and boring things like that weren't actually taking stuff out of the ground. Now, now those are sharply cutting their dividends, and so they're creating, people who were looking for safe income all of a sudden are really, getting slammed by this energy decline.
No safe income there for sure. So what will you be looking for in the days ahead?
What I'll be looking for in days ahead is the shape of the futures curve, because that tells you a lot about the oil market. What you always see quoted is the front month futures contract, but there are many months out there, and if there's a really, really steep dislocation between what a barrel of oil costs today versus what you can sell it for in 6 months or in a year, then that means that storage is getting close to being full, that the market is really being overwhelmed by this amount of crude oil being brought onto the market. And if that happens, then we can have, at least one more violent leg down in the price. And, so it probably isn't over yet. It's getting very interesting.
Very interesting indeed. Spencer Jakab, thank you so much for that.
Thank you.
Thanks.